Tom Clendon speaking here, and we're just about to go over a debrief of this question 1 involving France and Paris. Now, you're only really going to get a benefit from this debrief if you've already done the question. So if you haven't done the question, stop the video, go and do the question, and come back to this. Now, question 1 has its pre-populated spreadsheet and can either be manipulating a balance sheet, manipulating a cash flow, or manipulating a profit and loss account. And in this particular question, we're dealing with a consolidated financial statement. Now, the initial draft balance sheet is provided in Exhibit 3. This is a bit of a duplication. And to be honest, I don't normally bother with Exhibit 3. It's there. You can't change the number. You will do your answer to the spreadsheet in the response area, and that's duplicated there. What we're told in this particular question is, in the initial information, that France has bought 4 million of the 10 million shares in Paris. Therefore, we don't need a calculator. We know that's a 40% investment. And my gut tells me that means we've got an associate. What we've got, however, is 3 exhibits: details of France's investment, details of the legal case, and the draft accounts. You now need to open up the requirements and have a very brief skim read of the requirements. Now, you're told that in answering part A of the question, you don't need to read the exhibits. Well, let's do what we're told then, shall we? Let's not faff around by reading too much information and getting our heads full. But just before we do that, let's have a very brief overview. We're discussing, we're explaining. So part A is kind of an abstract. We're then very specifically calculating goodwill. We're then very specifically talking about an insurance, some kind of legal case. And then in part D, we're adjusting the pre-populated spreadsheet. And one of the exam technique approaches is to try and integrate and answer the question holistically. And I'll be demonstrating that, in due course. But first things first, there is no need to refer to the exhibits when answering part A of the question. All right. And what I want to do, therefore, is to kind of crack on and, control, copy, paste, and have a look at part A of this question. So control, copy, paste, put that in my Word response area, and let me then spend a moment briefly reformatting. I don't have to read any of the exhibits at this stage. I'm doing what I'm told, and I'm just reformatting briefly. We must answer the question set. Let's start at the beginning. Discussing what circumstances France would be correct in accounting for the investment in the associate and how it would then be accounted for in the France group accounts. The most significant word there is and, because that splits the requirement into 2. The first requirement is to discuss the circumstances that it would be correct to have it as an associate. Now, if you remember when we read the initial information, we bought 4 million of the 10 million. It's a 40% relationship. But we've got to discuss the circumstances that would be correct and then how it would be accounted for. And this is on the basis that we're looking at it as an associate. Now, you have access to a nice, neat, typed answer, but I'm going to suggest to you that in any answer, a marker is looking for that key word, that key phrase, significant influence. And significant influence is not a number, but it comes from having board representation. And that's another phrase you should be including in your answer. If you want to elaborate it slightly, you can talk about trading links and staff exchanges, but you've got to be careful that you don't spend too much time. Now, there is a rebuttable assumption that you have an associate status if you have more than 20%, but less than 50%. I would encourage you to write in proper sentences. This is me doing a high-level debrief. I'm highlighting the key technical terms and structure of the answer. It's 4 marks, so I'm thinking 1 mark per valid point. And there are 2 structures to A part 1. How are associates accounted for? We're looking for a key word. Markers are looking for the word equity accounting, and a brief description of equity accounting means that you are representing everything in a single line. And let's illustrate, or let's explain further what that means. Because if you've got a group balance sheet, what you're including in equity accounting is the investment in the associate, which will then every year increase by the share of the post-acquisition retained, the retained profits, the retained earnings. Yeah? And that's a key phrase. But if you want to think about the group P&L, then you're including a single line, and that single line is the income from the associate, and it will be the associate or our share of the associate's profit after tax. Look at your own answer and reflect. Was it broken down into circumstances? Was it broken down into accounting? Do you feel that you've earned 2 marks for the circumstances and 2 marks for the accounting? My answer that I'm producing for you here live, so to speak, isn't polished. You need to make these into proper sentences. You have access to the full answer. I am here to provide you with kind of exam technique and further explanation in my debrief. A part 2, another 4 marks. And another key word there of and. Now this time we're going lateral because it's a 40% relationship. Of course it's an associate, or of course it's probably an associate. But we're asked to say in what circumstances would it be a sub? Or what are the circumstances that France would classify Paris as a subsidiary? And it's a bizarre set of circumstances. Yeah, we've got to answer the question. And how is a sub then accounted for in the France group accounts? Now, the circumstances that you would include it as a subsidiary, the absolutely key word we're looking for is control. The definition of a sub is not a number. The definition of a sub is it's something that you can control. And there's a mnemonic. I love mnemonics. I love these little shortcuts. PEA. To have control, you have to have the power over the operating activities. You have to have the exposure to variable returns. And we do have, because at 40%, you've got that exposure to variable returns. You do well if the company does well. You do badly if it doesn't do so well. You know, you're in it. And you have to have the ability to use the power. All right? Now, with a holding of only 40%, it's not that the force is not with you. You need something extra. You need some extra evidence that you have control. All right? And so the simplest one, I think, would be an agreement with other shareholders. If you've got If you own 40% and your mate, your friend, your school chum, whatever, owns 20%, and they say, look, okay, let's have an agreement. They'll keep the shares. They'll receive the dividend. They can sell them if they want to, but I'll vote. They'll give me the vote. Yeah, so I know that I've got an agreement. You've then got control. And bizarrely, you would have a non-controlling interest of 60%. It is possible also that you could talk about warrants and options that can be exercised. Yeah. So that could be something else you could talk about. You could talk about the dispersion of the other shareholdings if they're unconnected. But it's only 2 marks. You're getting 1 mark for dealing with control in a proper sentence and trying to say that control is about power, exposure, and ability. So you're having to rein in. I'm having to rein in my knowledge and enthusiasm to make sure that I don't run out of time. How do you account for a sub? Well, you go for a line by line aggregation. You go for a line by line consolidation in full. We include all of the subs plant, all of the subs inventory, all of the subs turnover, all of the subs cost of sales, even though we only own 60%. This is because of stewardship. Yeah, this is because of stewardship. We are in control, therefore we are accountable for everything. I suppose the key phrase I should have used to begin with really is acquisition accounting. And acquisition accounting means you have a line by line aggregation in full, yeah, of the subs assets, of the subs liabilities in the group statement of financial position, and of the subs income and expenses. Of course, acquisition accounting also involves recognizing goodwill and non-controlling interest. This needs to be polished, but I am giving you a high-level debrief. I want you to think about using subheadings, yeah, because we've got that keyword and. And if I've said it once, I'm saying it again. In requirement of A Part 3, we are not having to have read the exhibits. We've got on with it. And we've got that keyword and. Explain how goodwill arises. Ladies and gentlemen, I've seen this in past examination questions, and I hope I live long enough to see it in future examination questions. It's a classic question. Explain how goodwill arises. It arises in the group accounts. It's a consolidation adjustment. It arises when the controlling interest, in other words, the parent's investment and the non-controlling interest are in aggregate, greater than the fair value of the net assets that are acquired. Yeah, that is basically how goodwill arises. That is basically how goodwill arises. Yeah. And how is it accounted for? How is goodwill accounted for in the group accounts? Yeah. How is goodwill accounted for in the group accounts? Well, when it's a premium, which is what I suggested, then it's an intangible asset that is then subject to an annual impairment review. Now, you could argue that what we've done here is to earn 2 marks. If they were slightly polished, you've got access to my full answer. And you may say, well, 2 out of 3 is good enough. You could, I suppose, talk about the NCI business, or you could say if it's a discount, if it's a discount, in other words, if it's not a premium, then we recognize here an immediate profit. Look, I'll be honest with you. you should feel fairly confident about this part of the question. It's relatively knowledge based. There's certainly an overlap with FR, and there's no intimidating manipulation of the spreadsheet. So, thank you for bearing with me, but we are now about to deep dive into the spreadsheet story and the rest of the question. And so perhaps I'm going to slow down slightly, and perhaps I am going to provide you with a comprehensive answer, and one that I'm going to justify in what I'm doing. In order to answer part B, I've got to use the information in Exhibit 1, and I've got to calculate the goodwill arising on the acquisition of Paris that has been consolidated into the draft group accounts. I've got to calculate goodwill, but I've got to use the information in Exhibit number 1, and therefore I am now fully digesting the information that is given in Exhibit number 1. And in Exhibit number 1, to be honest, quite a lot of information is given, and it's important that we understand what is going on. Now, we've teased ourselves in the opening part of the question that having a 40% holding in theory could be an associate or it could be a sub. It's most likely to be an associate. And we're told here that Paris is in fact an associate. But in the draft accounts we've been given, it was consolidated as a subsidiary incorrectly. So it was incorrectly classified as a sub, then it was correctly consolidated as a sub, but we should have been applying equity accounting. So the trick of the question is we're having not to add a new sub in, but we're having to remove the figures that were included as consolidation accounting, rip them out. And we've got to calculate the goodwill arising on the acquisition of Paris, that has been consolidated in the draft accounts. And we've got the information to do that. The investment in Paris is 20 million cash, 20 million bonds, redeemable in 2 years. Now, there's something funny about these bonds because they're zero coupon bonds. We'll come back to that later. But the 20 million for the bonds, this is the figure used in the calculation of goodwill. All right. And I've got to remove the figure that's been included. NCI is measured at fair value and the share price is 1.5. So, okay, I've got that. And then I've got fair values that I should be using to calculate goodwill. And then there's a story around the deferred tax implication. So there's no explanation required. What there is a need for a calculation. Now you can do that calculation in the spreadsheet, which I have done in my kind of model answer, or ultimately, if you wanted to, you could do the calculation in terms of your spreadsheet functionality. I don't mind. Let's have a look at the investment. They would have calculated the investment. Yeah, and they use the cash and they use the zero coupon bonds. So the way they did it was to bring in 40,000. All right, that's what they did. The non-controlling interest is at fair value, and that means that we are using the share price. Now the share price is given to us at $1.50. The share price of the sub was given to us at $1.50. Now we need to know how many shares are in the non-controlling interest. Remember that France has consolidated it as a sub. It owns 4 million of the 10 million shares. And therefore, to that extent, yeah, there are 6 million shares that France doesn't own. It would have done this. Yeah, it would have done this. The correct measure of NCI was used in the determination of goodwill. All right. I don't need a calculator. I don't need a spreadsheet to know that 1.5 times 6 is 9 million. What I've then got to think about is the fair value of the net assets at the date of acquisition. Now, at the date of acquisition, I won't use the book value. I will use the fair value, and I use the fair value of 13,000. Hold it. If you've done that, it's okay, but it's wrong. And the reason that it's wrong is because the deferred tax wasn't taken into account on the 13. How do I know? Because I've read the question. In addition to the above, the deferred tax implications on the fair value adjustments. The fair value adjustments is +4. 13 is the fair value. Book value was 9. So there's a net fair value adjustment positive gain of 4. That's a taxable temporary difference. That's a taxable temporary difference. And therefore, what we have is an additional deferred taxation liability, yeah, of 1,200. And I'm leaving an audit trail and basically saying that the fair value of my net assets should have been 11,000, yeah, 800, 11,800. What I can now do is to use my calculator. So I've got here 49,000, and I then take away from that 11,800. And hey presto, this gives me the goodwill of 37,200 as the goodwill that was consolidated into the draft group accounts. If you got the figure of 35,341, respect. If you got the figure of 35,341, and one or two of you would have done, you've overcomplicated the matter because you've calculated the true goodwill, yeah, because you've done the correct adjustment on the investment. But the right answer is 37,200. Now, there's two different ways that I want to go here. If I am applying aggressively exam technique, then I want to go into my spreadsheet and I just want to say, right, okay, look, you know, I've done this. I'm answering the question. And what am I doing here? I am minusing 37,200 because that's the goodwill that had been included. And I'll call that working one, and I'll call that working one. But I do want to answer the question holistically. And in my head, I'm full of the adjustments that were also have made in calculating that goodwill and the information that was given to us, yeah, in exhibit number 1. Because if we are saying it's no longer a sub, then we've got to also effectively remove the consolidation of the PPE of 11,000. We've got to remove the inventory. The acquisition was made on the last day of the year, so that stock still won't have been sold. And we've got to remove the current liabilities. And what I'm doing here is I think I'm earning myself some easy marks because I think these are low-hanging fruit. Yeah, I'm just picking them out. Now, what gets a little bit more sophisticated is that we had calculated when we did the Goodwill, we had calculated that there'd also been a deferred tax of 1,200. So we've also got to remove that deferred tax of 1,200 as well. All right. And we've left a little bit of an audit trail in order to do that. Maybe I'm pushing a little bit more, but if it is acquisition accounting, we included the goodwill, we consolidated the assets and liabilities, and we also would have included a non-controlling interest. So because I'm reversing out the consolidation, I've got to remove this NCI. This NCI figure here also needs to be, corrected as I rip out the NCI that I put in, and that's the figure of 9,000. Own figure rule. If you miscalculated the NCI, fair enough, you would still get the mark though, for removing the wrong figure. Now, although I'm removing, what I should have done is apply equity accounting. So the investment in Paris should have been shown as a single line. And therefore, it's queued up already. We are going to put in, for now, the figure of 40,000. Don't bother thinking too much in debits and credits and checking that all of these adjustments actually net cancel out. Life's too short in the exam. You've got to be aggressive. You've got to take risks. You've got to move on. JMO, just move on. Having said that, I am now going to be a little bit of a hypocrite because I am teaching. I am debriefing. And some of you perhaps won't have liked the fact that I've worked out the goodwill in the word processing area. If you wanted to, you could have also obviously worked out the goodwill in the word in the spreadsheet functionality, over here. So of course you can do this. Now clearly it's the correct answer, and clearly it's okay to do it using the spreadsheet functionality. The risk though is leaving an audit trail when you're introducing new numbers. And what I would encourage you to do, even if it slows you down momentarily, is to leave some kind of an audit trail around the deferred tax adjustment in this particular context, because you are dealing with the the deferred tax adjustment there of 1,200, and you're explaining where that information has come from. So let's move on and let me deal with what is arguably one of the most technical and tricky parts of the question. And if you didn't get this bit right, don't beat yourself up. It does relate to financial instruments, and it does relate to the fact that France has recorded the 20 million zero coupon bonds, which will be redeemed in par in 2 years' time, and it's recorded them at their nominal value. It's recorded them at 20 million, and that is technically an incorrect thing to do. You can see there the zero bonds are there at 20 million. And what I want to do is to make a necessary adjustment to those bonds. Okay? And this is part of the answer. You could do it a bit later. Probably most of you sort of missed it out, and maybe that's no bad thing in terms of time management. But I want to improve your knowledge as well as improve your exam technique. This is me now taking a little bit of a time out to try and make sure you understand what is going on. Now, these are zero coupon bonds. France has an obligation to pay 20 million in 2 years' time, and there is no interest that is paid. So the bonds should be measured at fair value. Yeah, the initial recognition of the liability should be at fair value. And in this particular case, because we're not paying out interest as we go, it's not 20 million. Yeah, it's going to be the present value of the future cash flow, the one-off, the present value of the future cash flow. I am lapsing into teaching mode. Yeah, so it has been recorded. It has been recorded at 20 million. It has been recorded at 20 million. It should be recorded. Yeah, it should be recorded at the present value of the future cash flow. So effectively, that means 20,000. Yeah, at 1.05 to the power 2. Yeah, because the time value of money is rolling at 5%. Now, for me, the easiest thing to do would be to do it in a calculator and to do it in a scientific calculator as follows. So we take the 20,000, we then divide that by 1.05, and we say that's to the power 2. So in fact, the amount of the liability should be, 18,000. The amount of the liability should be 18,000. I'm going to call that 141. But the adjustment that we're making is from the original figure of 20,000. So the adjustment that we are making, is going to be 1,859. Okay, so if I'm being aggressive, I've got an adjustment to make. I've left an audit trail here. I've got an adjustment to make in my response area here, because the investment in the associate should have been recorded at the fair value of the consideration that you gave. Yeah, so it should have been recorded at 18,141. The bond itself, again, should have been recorded at 18,141. You don't normally have to do this discounting for initial recognition of liabilities. You do with split equity accounting, and this is another little exception. You've got a 0 coupon bond. It's been incorrectly recorded. We're having to do the adjustment. You don't get marks for the total column, so don't start dealing with the total column at all. Of course, you can do the calculation in the Excel functionality. You are an adult. You are an independent learner. You calculate and leave an audit trail the quickest way. Do not do it both ways. All right, I'm showing you both ways to try and make everybody understand. And I've spent, from an exam technique point of view, too long explaining this. We move. And we move to considering the next part of the question. And the next part of the question involves us now reading Exhibit 2. So let's have a look about this legal case and this insurance claim. All right. Using the information in Exhibit 2, explain. So this is all about words. Yeah. And let me just go back and make sure that I understand how many marks we have got for this, because it's been lost. We have got here 4 marks. All right. So there are 4 marks available for what we're doing here. And that tempers my length of answer. So during the current year, we've provided some consultancy. What we've done, the customers had problems. So the customer is suing us. They've taken out legal action. with only a 25% chance that we can win, there's a high chance, 75% chance, we will be required to pay damages of 1.6. Now, the argument is, overall, there's no loss because we're covered by insurance. And on that basis, nothing has been provided or disclosed. You don't get marks for being a parrot. I know it's ISA 37. You probably know it's ISA 37. No marks. A provision is a liability of uncertain timing or amount. In order for it to be recognised, all three conditions must be met. There has to be a present obligation, which is legal or constructive, arising from a past event, and there has to be a probable outflow of economic benefit, which is capable of reliable measurement. You write that out, time goes by, that is not answering the question. You've got to explain to the directors of France what is going on in context. So we provide, for the damages, for the liability, if all three conditions are met at the reporting date. The past event that we've specifically got is the legal case against us. Is the claim of the faulty installation, the faulty advice, and the legal claim. The 75% is probable. The 75% means it is probable, and we've got a figure given to us at 1.6 million, which is a reliable estimate, and therefore the conclusion that I'm going to make, we don't provide 1.2. ISA 37 is all or nothing. Once you've met that threshold, i.e. over 50%, it's probable. If it's probable we're going to pay out 1.6 million, we provide in full. So we're going to provide in full. That is going to be a liability. We're going to provide in full. And we're going to charge that as an expense. And that is going to be charged as an expense. That's what we're going to be doing. Now, as a totally separate issue, we consider the insurance claim. We don't aggregate the two together. So we think about the insurance claim as a contingent asset. That's the technical term. Is it a contingent asset? Is the contingent asset of the insurance claim? Now, if we are going to recognize this as an asset, it has to be virtually certain. But to me, it's not virtually certain. We haven't got, the loss adjusters haven't agreed it. It's not in writing. We're covered by, we will make a claim. We haven't even made a claim yet. So how can we claim it's virtually certain? We can't. And therefore, there is no asset. And there is a disclosure. I mean, if you think it's probable, you could argue that it's not even probable. But the point is there is no asset. But there is a disclosure if it's judged probable that we could win this case. All right, but we haven't even made the claim yet. So the accounting treatment is incorrect. What we've now got to do is to go back and make sure that we update our pre-populated spreadsheet with a 1.6 million liability. And here we are. We are looking here at part C. I don't see, this is to do with the provision. This is to do with the liability. And we are recognizing this against profits. Is it a current liability? Is it a non-current liability? I haven't got the full information. It doesn't really matter, therefore, which one. But I'm going to suggest it's a non-current liability. These court cases always seem to drag on. Don't beat yourself up if you put it as a current liability. And this is going to be reducing profits. And therefore, we've got a minus there. I repeat, do not aggregate the total column. Yeah, do not aggregate the total column. There are no marks for doing so. And there is a real danger of a trap, of time and panicking yourself. The balance sheet doesn't have to balance for you to pass this exam. To pass this exam, you need to do all 4 questions. All right. And there is an obsession, or some of you have an obsession with question 1 about getting it exactly right because it involves numbers. Don't have that obsession. Be smart. You're here to pass an exam. I'm here to teach you to pass the exam. And that is partly about technical knowledge, but it's also about exam technique. Thank you for listening to this debrief. This was an interesting question where we were unconsolidating, deconsolidating a subsidiary that had been consolidated but shouldn't have been, because actually we were told in the question that the investment in Paris was an associate, but it had been consolidated as a sub. Therefore, we were ripping out the goodwill, ripping out the NCI, ripping out the assets and liabilities of the subsidiary at the date of acquisition, which was at the year-end date, and also that deferred tax. Thank you. Onwards and upwards. My name is Tom Clendon. Come on.